Thousands of Americans move to Florida, Texas, or Tennessee because they expect retirement to become cheaper. But here's the trap. A state can charge zero income tax and still take more of your retirement money through property taxes, insurance, healthcare, and everyday spending. And one of the states retirees often avoid may actually let you keep far more than expected. Today, we're comparing 5 of the most retirement-friendly states, and 5 states where taxes and hidden expenses can quietly shrink your income in 2026. But this is not another list based on one headline number. We're going to examine Social Security, pensions, 401k and IRA withdrawals, property taxes, sales taxes, insurance, estate planning, and the cost of actually living there. Because the best state for a retiree receiving mostly Social Security may be completely different from the best state for someone withdrawing $90,000 a year from a traditional IRA. If you want retirement and money explained without the confusing financial language, subscribe to the Money System, like this video, and stay until the end, because I'll give you a simple 5-step test you can use before moving anywhere. Let's begin. Why no income tax doesn't always mean low tax. Imagine Robert and Linda. They are both 67 and receive a combined $48,000 a year from Social Security. They also withdraw $42,000 from a traditional IRA. Their total annual retirement income is $90,000. They currently live in a state that taxes part of their IRA withdrawals, so moving to a state with no personal income tax sounds like an obvious victory. But suppose the move saves them $3,000 a year in state income taxes. That sounds great. Until their homeowners insurance increases by $4,500, their property tax rises by $1,800, and their auto insurance costs another $1,000. They saved $3,000 in one column, but spent $7,300 in 3 others. Their tax-saving move is now costing them more than $4,000 every year. Over 20 years, that is more than $80,000 before considering inflation or investment growth. That is how the system works. Every state needs revenue. Some collect more from income. Others depend heavily on property taxes, sales taxes, tourism, fuel taxes, insurance-related charges, or local assessments. So instead of asking, does this state have an income tax, ask a much better question. How much will living in this state cost someone with my income, property, health needs, and spending habits? With that framework in mind, let's examine 5 states that can be financially difficult for retirees. The 5 toughest states for many retirees. Important distinction: worst does not mean nobody should retire there. It means these states can produce a heavier financial burden for retirees, with significant taxable withdrawals, pensions, property, or estates. Number 5. Vermont. Vermont offers natural beauty, small communities, and a slower pace of life. Financially, however, retirees need to look beyond the scenery. Vermont generally follows federal treatment for Social Security and then provides state-level relief based on income. That means some lower and middle-income retirees may qualify for an exemption, while retirees above the applicable limits can still face state tax on federally taxable benefits. Traditional pension income and withdrawals from tax-deferred retirement accounts can also be included in Vermont taxable income, unless a specific exemption applies. Then there are property taxes. Even if your retirement income is manageable, owning a valuable home can create a substantial annual expense. Vermont does offer property tax relief programs, but eligibility and benefits depend on household income and other requirements. The lesson is not that Vermont is automatically unaffordable. It is that a retiree with a large pension, major IRA withdrawals, and an expensive home may feel pressure from several directions at once. Number 4. Minnesota. Minnesota is known for strong healthcare systems and a relatively high quality of life. Those are meaningful retirement advantages. But the state also has a progressive income tax structure, with 2026 rates ranging from 5.35% to 9.85%. Pension income is generally taxable, and traditional IRA and 401k distributions can also be taxed when included in federal taxable income. Minnesota provides Social Security subtraction rules and other targeted deductions, so saying that every retiree pays tax on every dollar of Social Security would be inaccurate. The final result depends on filing status, provisional income, and eligibility for the available subtraction. Here is the practical problem. Retirees can cross those income limits without feeling wealthy. A pension required minimum distributions, interest, dividends, and half of a Social Security benefit can combine to raise provisional income. A large one-time IRA withdrawal can also change the result for that year. Minnesota may work well for a retiree who values healthcare access and can use its deductions. But someone with a large pension and substantial tax-deferred savings should calculate the state tax before moving. Minnesota's official guidance confirms that pensions are generally taxable, while Social Security relief depends on specific subtraction rules. Minnesota Department of Revenue. Number 3, California. California gives retirees one major break. It does not tax Social Security benefits. That sounds encouraging, but most other retirement income is treated differently. Traditional IRA withdrawals, 401k distributions, private pensions, rental income, interest, and taxable investment gains can be subject to California income tax. California's highest marginal rate will not apply to the average retiree. That is an important point, because videos often use the top rate to frighten everyone. Your marginal rate depends on your actual taxable income. Still, a retiree withdrawing significant amounts from tax-deferred accounts may face a larger state tax bill than in states that exempt retirement distributions. Housing is another dividing line. A longtime California homeowner with a low mortgage and a protected property tax assessment may be in a very different position from a new retiree purchasing a home at today's market value. The first retiree may find staying financially reasonable. The second could face a much higher housing cost from the beginning. California officially excludes Social Security from state taxable income, but that protection does not automatically extend to pensions or traditional retirement account withdrawals. California Franchise Tax Board. Number 2, Oregon. Oregon does not tax Social Security benefits, which is a meaningful advantage. But if you become an Oregon resident, pension income and many other sources of retirement income are generally taxable. That can include traditional IRA distributions, 401k withdrawals, pension payments, interest, dividends, and capital gains, subject to available deductions or credits. For a retiree living mostly on Social Security, Oregon may not look particularly harsh. But consider someone receiving $30,000 from Social Security, a $35,000 pension, and $40,000 from a traditional IRA. The Social Security may escape Oregon income tax, while much of the remaining $75,000 can still enter the state tax calculation. Oregon can therefore be much more expensive for a retiree with a large pension or tax-deferred portfolio than for someone with the same total income coming from different sources. That is why income composition matters just as much as the total. The Oregon Department of Revenue confirms that Social Security is exempt, while resident pension income is generally taxable. Oregon Department of Revenue. Number 1, New Jersey. New Jersey is complicated, and that makes it dangerous to summarize with one sentence. Let's begin with the positives. New Jersey does not tax Social Security benefits. It also provides a retirement income exclusion for eligible residents who are at least 62 or meet certain disability requirements. For 2026 planning, qualifying taxpayers with total income of $150,000 or less may be able to exclude some pension, annuity, or IRA income. The available exclusion becomes less generous within the higher portion of that income range. That means the statement New Jersey taxes every retirement withdrawal is simply wrong, but there is a catch. If your income rises above the eligibility limit, the exclusion can disappear. That creates a planning problem for retirees who take a large IRA distribution, realize a major gain, or receive substantial income from multiple sources. New Jersey also carries famously high property tax burdens in many communities. Property tax relief programs can help eligible senior homeowners, but they do not make every house affordable for every retiree. Estate planning requires nuance too. New Jersey no longer imposes its former state estate tax, but it does retain an inheritance tax. Whether that tax applies depends heavily on who receives the assets. Transfers to spouses, children, parents, and certain other close relatives receive different treatment from transfers to more distant relatives or unrelated beneficiaries. So the claim that New Jersey simply takes a fixed percentage from every estate is incorrect. New Jersey can be manageable for a moderate income retiree who qualifies for its exclusions and property tax relief, but it can become expensive for someone with high taxable income, valuable property, or an estate intended for non-exempt beneficiaries. The state's current retirement exclusion and inheritance rules are explained by the New Jersey Division of Taxation. Before we get to the 5 most favorable states, comment below. Which state are you considering for retirement? And what is the biggest concern? Taxes, housing, healthcare, weather, or insurance? And if this breakdown is helping you see the full system, like the video and subscribe. It helps us continue producing practical retirement content based on how the numbers actually work. Now let's look at the states that may allow retirees to keep more of their income. The 5 most retirement-friendly states. Again, there is no universal winner. These states stand out primarily because of their treatment of retirement income, but everyone comes with a trade-off. Number 5, Iowa. Iowa has quietly become one of the strongest retirement income states in the country. Qualifying residents who are 55 or older can exclude eligible retirement income from Iowa taxation. That can include pensions, traditional IRA withdrawals, 401k distributions, annuities, employer retirement plans, and certain deferred compensation income. Iowa also does not tax Social Security benefits. This creates a powerful combination. A qualifying retiree receiving Social Security, a pension, and IRA withdrawals could owe little or no Iowa income tax on those income sources. However, the word qualifying matters. The exclusion does not automatically make rental income, interest, business income, dividends, or every capital gain tax-free. Retirees younger than 55 may also receive different treatment unless another qualification applies. Iowa's advantage is therefore strongest for retirees whose cash flow comes primarily from recognized retirement plans. The retirement income exclusion is confirmed by the Iowa Department of Revenue. Number 4, Nevada. Nevada keeps the income tax side extremely simple. There is no broad individual state income tax. As a result, Social Security, pensions, and traditional retirement account distributions do not create a Nevada personal income tax bill. Nevada also avoids a separate state estate or inheritance tax. But simplicity does not mean zero financial risk. Healthcare access can vary significantly depending on where you live. Retiring near Las Vegas or Reno is different from living in a remote part of the state. Water, cooling costs, housing prices, and insurance should also be included in the calculation. Nevada is especially attractive to retirees with high taxable withdrawals because the potential state income tax savings rise with the amount they withdraw. Someone living almost entirely on Social Security may receive a smaller tax advantage because many other states already exempt Social Security. Number 3, Pennsylvania. Pennsylvania is one of the most overlooked retirement destinations. The state has an individual income tax, but most qualifying retirement income received after reaching the applicable retirement age is not taxed. That generally includes Social Security, pension payments, and eligible distributions from 401ks and IRAs. This can make Pennsylvania surprisingly competitive with states that have no personal income tax at all. But Pennsylvania has its own trade-offs. Property taxes can be significant in some areas. Municipal finances differ across the state, and Pennsylvania has an inheritance tax whose rate depends on the beneficiary's relationship to the person who died. So Pennsylvania may be excellent for retirement cash flow while requiring extra attention to property and estate planning. The state's tax guide identifies Social Security and qualifying retirement plan distributions as non-taxable compensation. Pennsylvania Department of Revenue. Number 2, Tennessee. Tennessee has no broad personal income tax. Its former tax on certain interest and dividend income was fully repealed beginning in 2021. That means pensions, Social Security, IRA withdrawals, 401k distributions, interest, and dividends generally avoid Tennessee personal income tax. Property taxes are also relatively manageable in many areas. But Tennessee collects revenue through spending. State and local sales taxes can be high, and groceries are still subject to state taxation, although at a lower state rate than many other goods. This produces an interesting difference between two retirees. A high-income retiree who saves and invests a large part of their money may benefit greatly from Tennessee's structure. A retiree with modest income who spends nearly every dollar on taxable necessities may feel less of an advantage because sales taxes consume a larger percentage of the household budget. Tennessee works particularly well for retirees with substantial taxable investment or retirement income, but the spending side cannot be ignored. Number 1. Florida. Florida remains one of America's most popular retirement destinations for good reasons. It has no broad individual state income tax. Social Security, pensions, IRA withdrawals, 401k distributions, and investment income therefore avoid Florida personal income tax. Florida also offers homestead protections for qualifying permanent residents. Its Save Our Homes limitation generally restricts annual increases in the assessed value of an established homestead to 3%, or the change in the Consumer Price Index, whichever is lower. But notice the wording, assessed value. That does not guarantee that the entire property tax bill can never rise, and a new buyer starts from a new assessment after purchasing the property. Florida's largest threat is often not income tax. It is insurance. Homeowners insurance, flood coverage, condominium assessments, auto insurance, storm exposure, and housing costs can erase the income tax advantage for some retirees. Imagine saving $4,000 in state income tax, but paying $7,000 more for housing and insurance. Florida did not become cheaper. The expense simply moved to another column. Florida can still be the strongest overall option for the right retiree, especially someone with large taxable withdrawals, secure housing, and manageable insurance costs. Its homestead exemption and assessment limitation are explained by the Florida Department of Revenue. The 5-step retirement state test. Before moving, run these 5 calculations. Step 1. Map your income. Separate your expected income into categories: Social Security, traditional IRA, and 401k distributions, Roth withdrawals, pensions, interest and dividends, rental income, capital gains, part-time employment. Do not apply one tax rate to the entire amount. States treat these categories differently. Step 2. Estimate taxable withdrawals over time. Do not calculate only your first retirement year. Your required minimum distributions may increase later. A surviving spouse may eventually file as single and face less favorable brackets. Selling an investment or completing a Roth conversion can also create an unusually high income year. Run projections for age 65, age 73, age 80, and for the surviving spouse. Step 3. Price the actual property. Do not compare statewide property tax averages. Choose a real house in a real county and request an estimate based on the purchase price you would pay. Existing homeowners may benefit from assessment limitations that a new buyer does not immediately inherit. Step 4. Add insurance and healthcare. Price homeowners, flood, windstorm, auto, Medicare supplement or Medicare Advantage coverage, and long-term care considerations. Then check the distance to hospitals, primary care physicians, and specialists. A state is not truly affordable if receiving essential medical care requires expensive travel or limited provider options. Step 5. Build a 2-0 YEAR cost projection. Include inflation for housing, insurance, healthcare, utilities, and taxes. Then compare the lifetime cost, not just the first-year tax saving. A move that saves $5,000 in year 1 could become expensive if insurance rises faster than your income. The best retirement state is not necessarily the state with the lowest income tax rate. It is the state where your specific income receives favorable treatment, your housing remains affordable, healthcare is accessible, insurance is manageable, and the lifestyle is one you can sustain for the next 20 or 30 years. Iowa and Pennsylvania can be excellent for retirees living on traditional retirement income. Nevada and Tennessee can favor retirees with larger taxable cash flows. Florida remains powerful, but only when housing and insurance do not overwhelm the tax savings. Meanwhile, Vermont, Minnesota, California, Oregon, and New Jersey may require more careful planning, but none of them is automatically wrong for every retiree. The real mistake is moving because of one number. Before changing states, compare your complete financial system. If this video helped you understand the difference between a tax-friendly headline and a genuinely affordable retirement, subscribe to The Money System, like the video, and share it with someone planning a move. And comment with the 2 states you want us to compare next. Because where you retire matters, but how your retirement income is structured may matter even more. This content is for educational and entertainment purposes only. Tax rules change, and individual results vary. Consult a qualified tax or financial professional before making relocation or retirement decisions.